Hello and welcome again to the next installment in the Huntsville I2C boot camp for non-accountants. And I am Roger Spain with Warren Averett, CPAs and advisors, here to talk today about the cash cycle, managing the cash cycle. In the past, we have covered some of the basics of financial statements, what comprises a financial statement, how accounting works, double entry bookkeeping, and many of the rudimentary or basics relative to accounting. Today we're going to get more into how to actually manage your business and how to perform well, particularly as it relates to managing your cash. So that's the focus of this installment. If we jump right in, we think about our operations, any company's operations. You buy raw materials, you convert raw materials into some sort of finished good or product, and then you sell that finished good or product, and you take an order, or you book an account receivable, and hopefully, ultimately, you collect the cash associated with that sale. Here's what we're going to talk about today. The reality is those activities require the use of cash. You have to buy materials, pay for materials, and you have to make sales and then collect on sales. And we're going to walk through that cycle and how it impacts your cash. And ultimately, we're going to quantify the cost of that. And I want you to be aware that whether you actually make a product using raw materials to convert that to a finished good, or even if you're a service company or in the service industry, the same thing applies. So Warren Averett, as a service provider, has the same issue. However, instead of buying raw materials and converting that to finished goods and selling, we incur the cost of payroll, and other services companies will do the same thing, incur payroll cost in order to perform services and ultimately bill for those services. So don't get hung up on whether or not we're talking about purchasing raw materials, or in the case of a service company, think about that in terms of payroll and your cost, your raw cost being raw materials cost being payroll. As we start to work through this cycle, we think about our operations, and we buy materials or we incur payroll cost. And when we do that, we take a few days to get the materials, or we spend time working on whatever project it is we're working on. And that takes, all total, let's say 10 days to get the materials, 15 days in production, and then 30 days to make that into a finished good. So, here already it's taken us, let's say, in this case, 55 days, 10 plus 15 plus 30 to order materials and then convert that into a finished good. So we've got 55 days in the process. Then we sell that material, and then we take a couple of days to get that shipped out and make the sale. So we've worked through now 57 days in total in order to work from raw materials or payroll, initiation of payroll, all the way through till we actually have something we can bill for. Now let's talk about how the operations continue from there on the sales side. So we get a customer who places an order, who makes a purchase. It takes us a couple of days to fill the order and get the invoice sent to the customer, let's say 3 days in this case. Then let's say it takes us 33 days to collect on the accounts receivable. So now we have 33 days in total in the process of going from an order to making that, to converting that to cash in our bank account. Now what we want to think about is, at the same time, we bought raw materials or we incurred payroll, either way, and either we bought raw materials and then ultimately we have to pay for it, or our employees work and then between the time they work and the time the cash goes out the door, it takes many days before employees get paid. There's a lag there between a day worked and a day's pay collected. So let's work through what that could look like. That can be, let's say, 10 days between when we purchase material until we receive the material. And then once we get the accounts payable, let's say it takes us 10 days to pay the vendor invoice that we receive. So that's a total of 20 days between purchasing the material and paying for the material. So now we've gone through 57 days of working through the purchase cycle. We've gone through 33 days on the sales and collections cycle. And now we've worked through 20 days on the payable cycle for the cash to go out the door. Well, let's talk about what this means in terms of cash conversion. If we have days sales outstanding, we talked about of 33 days, that was the second cycle we went through, plus the days of the inventory cycle, that's 57 days. So we've got from the time that we have to pay for something until we can convert it back into sales that we collect, that is the function of these three things we have listed. It's the inventory purchasing activity of 57 days, plus the 33 days to collect on selling, minus the 20 days that it takes us to pay our vendor. So that's a total net of 70 days of cash conversion in this cycle. And again, that's based on each of those three cycles we just went through. So if you wanted to back up the video a little bit and go back through those, you're welcome to, but we are going to go through another example in just a minute. So now we have a 70-day cash conversion cycle, and let's quantify what that means to the company. If a company has $10 million of cost of goods sold, we divide that 10 million by the number of days in the year, and that comes up to about $27,400, $27,397 per day of cash that it costs us to cycle our goods that we resell or services that we sell through our company. And in this case, we computed a cash conversion cycle of 70 days. Well, 70 times 27,397 is a total measurement of liquidity used, cash used by the company for the purpose of cycling cost of goods sold of $1.9 million. Well, how much does that cost the company? So let's take a look at that. If the company has $1.9 million of liquidity or cash used to run its cost of goods sold through the company, and let's say that the company has a line of credit and the interest rate on that line of credit is 5%, well, then that's simple math. Multiplying 1.9 million times 5% tells us that we have about 96,000 of interest cost if we were to quantify the cost of cash at an approximate line of credit cost of 5%. Then using liquidity to cycle cost of goods sold through the company on an annual basis costs the company about $96,000. Using cash actually does cost money. So here we've quantified that for a $10 million cost of goods sold company of $96,000. Let's take a look at a second example and see what sort of impact a different cash conversion cycle in the same company can have in terms of the cost of the company. So let's very quickly go through. And let's say that instead of 57 days, it takes us 117 days to go from purchasing materials to actually shipping the materials out because we have made a sale. So in this case, we now have the finished goods conversion instead of being, I'm trying to remember exactly how many days that was before, but it was, I think 30 days. And here we're saying it takes us 90 days to convert goods to finished goods, raw materials to finished goods. So we've increased our inventory or production cycle from 57 days to 117 days because our production time is slower in this second hypothetical. Now let's go through the same thing, and let's say that we're a little slower in collecting. And instead of collecting in 30 days, it takes us 60 days to collect. And now let's say that we have the same 20 days to pay our accounts payable. So now we take the days sales outstanding, which is now 63 days. We take our days inventory outstanding, which is now 117 days. And we subtract, just as before, our accounts payable cycle of 20 days. So now our cash conversion cycle in this second hypothetical is 160 days. Let's work through the same example we did just a minute ago, and we have an annual cost of goods sold of $10 million. And that gives us, in this case, at 160 days, $4.383 million of liquidity or cash used as we cycle through the year. What's the cost of that? Well, let's use the same 5% on our line of credit that we used a minute ago, and we come up with $219,000 of interest expense in order to quantify the cost of this cash conversion cycle at 160 days versus the other example we looked at a minute ago, which was, I believe, 90 days. So now, by going from 90 days to 160 days, we have increased our cost to carry materials within the company from $96,000 in the first example to, I'm going to round and say, $220,000 in the second example. So it now cost us approximately $125,000 extra dollars because our cash conversion cycle is a little bit slower than in the first example. So that's about $10,000 a month. So as you can see, as we work through this example, a slower cash conversion cycle costs the company real money. I think this is something that people don't talk about often enough as they think about the cost of running a business and the cost of perhaps a slower cash conversion cycle. So I hope this was enlightening for you. It's a very quick example or walk through the process of quantifying the cost of a cash conversion cycle. So hopefully, again, this helps and creates, maybe a feeling of importance as it relates to speeding up that cash conversion cycle in order to get cash in the door more quickly and perhaps hold on to it just a little bit longer before you pay your vendors. So putting some numbers to it hopefully illustrates the importance of the issue. I hope this has been useful, and I look forward to speaking with you again in our next installment. But until then, I wish you the best. Thanks so much.